In this video, we're going to talk about income taxes. Now, a lot of people know that once a year you pay taxes to the federal government and the state government, but most people are unaware of how those taxes are calculated, where that amount comes from. Even the forms back in the day when forms were used, paper forms, and sometimes people still use them, the taxes are often already calculated for you. You don't even have to go through the calculation. But those come from somewhere, and we're going to talk about it. So, first thing we're going to do is kind of go through the steps of how you calculate the income tax. In particular, step here, this first step on this little table is you have a gross income. They call it the gross income. That's your total earnings, everything that you bring in for the year. Usually it's just from your job, but sometimes people have savings plans or investments, interest that have been earned on those investments. So that all goes into your income. From there, you can make certain adjustments. Not everybody can, but sometimes it can be done. And if you can do adjustments on your income, you can do that first. What is left is called the adjusted gross income deductions. They can do the standard deduction or itemized deduction, but you can deduct a certain amount from your income, and what is left is what they're actually going to tax. That's called the taxable income. Then the fourth step is when you actually calculate your taxes. We'll talk about that. And then the last step is if you have any sort of credits coming to you, you can go ahead and deduct that from the tax. And depending on what you've paid that year, you might get a refund or you might owe. So that's the final step. All right, so we're going to talk about some of the terminology and also do some of the calculations so that you can see how this works. So first thing here, $100 in wages, and then receive $95 of interest in a savings account. She was entitled to a personal exemption of $3,900 and took a standard deduction of $6,100. Okay, now some of this information is dated, meaning I think we're kind of basing a lot of this on 2018 tax information. So just be aware some of these might not be accurate. A standard deduction of $6,100 may not be the deduction this year. Okay, so before we get into that, let's go ahead and look at these three. So first thing we want to do is find the gross income. So gross income is how much she has actually brought in that year. So that'll be her wages, the $28,400 plus the interest, the $95. And yes, the federal government is going to make sure that you include every dollar in your income. So 28,000 $495 is her gross income. Okay, so this mentioning of a personal exemption. Now, I know that word exemption is not up in these steps here above, but it is considered an adjustment. So this is going to give us the adjusted gross income. I'm going to go ahead and label it AGI, and that's going to take that 28,495, and we will subtract that 3,900 exemption. All right, so that's going to give us, and I kind of pre-calculated this, so you may want to grab your calculator at this point to do these calculations with me. $24,595. And that's her adjusted gross income. Okay, now she's going to take the standard deduction of $6,100. So that means that her taxable income, so we're on step 3 now, her taxable income is going to be that 24,595 minus the standard deduction. So what's left is $18,495, and that is what the federal government is going to look at taxing. So that's what she has to pay taxes on. And that is a comma, not a decimal. All right, there we go. Okay, so let's go ahead and look at some terminology when you're talking about your filing status, and that's what's going to be used to calculate in step 4, the actual tax. So you could be single, and they define single as obviously people unmarried but it also could be people who are divorced. I misspelled that. Writing a little bit easier here. Okay. Now, if you're married filing jointly, that means you're married and you and your spouse are going to file a joint or a single tax return between the two of you. It's most common among married couples. Now, if you're married filing separately, that means you and your spouse have chosen to keep your income separate from each other. Didn't leave some space on that returns. Okay, now if you're head of household, that's defined to be unmarried, but with dependents. And a dependent is basically somebody you're paying at least half or the majority of the cost of supporting a child or maybe a parent who's elderly. Okay, so exemptions and deductions are subtracted from your gross income, your adjusted gross income. And exemptions are a reduction in income. For each person. And exemptions can be claimed for you and each varies from person to person. And a standard deduction is going to depend on your filing status, whether you're single or married filing jointly versus separately. That all kind of depends on that filing status. Whereas an itemized deduction is the sum of individual deductions which you're entitled. Now, I know a lot of us are familiar with the idea that people might receive deductions based on charitable contributions or different things that you can do to kind of receive these individual deductions to help lower your taxes. A lot of people did more itemized deductions up until a few years ago. And then Trump actually raised the standard deduction. So a lot less people were doing itemized deductions. They were just taking the standard deduction and using that. And look at an example of whether or not somebody wants to itemize or take the standard deduction. Okay, so you can either itemize or take the standard. Let's assume that your deductible expenditures for contributions to charity and state income taxes is $3,700 and $760. So let's calculate that for the itemized deduction. Then you would add those two together. So your contributions plus you get some on this. I think this might be an old version where you can take some state income taxes out. And that's going to be $4,460. All right. Otherwise, you can do the standard deduction of $6,100. And since this is the amount that's going to be subtracted to get you your taxable income, you want to do the majority. So you're going to want to do the standardized. You're going to want to take away $6,100 because then you'll pay less in taxes. Okay, so our system is based on a progressive income tax. That means that with higher taxable income pay, you're going to pay a higher tax rate. In other words, the more money you make, the more you pay in taxes. And this uses incomes, the actual income you bring in to do this calculation. So this is an old tax rate from 2013. And we'll use this for the next problem. It's all very similar to this setup. And in the homework, the online homework, I believe there are already references set up to what you'll be using in those questions. Just for reference though, our textbook here, our textbook does have I think the 2018, let me just scroll in here. Oh, there's that chart we saw in the notes for 2018. Single, okay, let's come back here. So we're going to use this kind of reference to do this problem below. So let's say Emily and Juan are married and they're going to file jointly. Okay, so real quick, then up here, we're looking at the second column of information. So just to kind of go through this then, up to $17,850, they're going to pay 10% in taxes. Up to $72,000, they're going to pay 15% in taxes. And then it just keeps growing. So it's a little bit annoying because every time there's a tax increase, first you have to calculate the taxes for the first row, and then that is no longer included in the income when you calculate the taxes for the second row. I'll show you how that works with this example. Okay, so here we go. So let's see, their combined wages were $75,300. They earned $2,000 rental property they own and $1,650 in interest. Okay, so that's going to go into their gross income. So I'm going to add those three things together here. I'm just going to write down that that's what I'm going to add. Plus 2,000 plus 1,650. So a total of $78,950. That is their gross income, how much they brought in that year. Okay, so for themselves, two children, they contributed plans and their itemized deductions total 96,000. I'm sorry, 9,006. Still use those things. So there are that 3,240 for their tax. We're going to go ahead and take that out. And that'll give us their AGI is 75,000. Oops. $75,710. All right. So based on what they totaled up to 10, so that's their itemized. Let's see what the standard deduction is for them for being married. Okay, so right here in this row, the standard deduction for married filing jointly is $12,200. So they're going to want to do the standard deduction. That is certainly more money. Okay, so then let's go ahead and calculate their taxable income. So that's the amount of money from part B, the $7,710. There we go. We're going to subtract that deduction of 12,200, and that gives us. I forgot that they also doing some exemptions, right? So $3,900 of exemptions as well. And they're going to do it 4 times. So here, I'm just going to do this all in one step. So 4 times 3,900, whatever that comes out to. Let's see, plugging that into the calculator, I'm going to get $47,910. So that is how much their taxable income is. That's what they're going to pay taxes on. Okay. So it doesn't matter if their gross income was $78,000, they're only going to pay taxes on the $47,000. So let's come back up here to the table. And that means then that they're going to fall into the second row category, right? They make up to 72,500. Obviously, they make less than that. So they're going to be in the 15% tax rate. That's the highest tax they're but they still have to pay the first row of taxes, the 10% tax up to the 17,850. So I'm going to calculate that. 17,850. So that is me figuring out the very first row of taxes, which by the way comes out to 1,785. Okay. Then we're going to subtract That's $17,000 from their taxable income. And that is what I'm going to pay the 15% on. It's out to 30,060. And then if I take here, I didn't calculate this, 30,060 times 15%, that's 4,509. And that is what they're going to pay in taxes added to the 1785. So a total of 6294. Okay, so we don't just hit it with 15%. In other words, if you paid 15% on this, I'm going to do this in green. If you did 15% on the 47, this 9, 10, that comes out to 7,000. 7186.5. So you don't have to calculate this. This is just me showing you that you're going to pay less in our system because we do this ranking. So you start by paying 10% taxes and then you move into the 15% taxes. Everything beyond the 10% row, you will then pay 15% on, and anything beyond the 15% row, you would pay 25% on. So we gradually raise the taxes, and that allows then for you not to be paying as much. So as you can see, if we just did 15%, you would be paying significantly more, $900 more in taxes. But by just doing this kind of slow ranking, we allow it to be a little bit less. Okay. So there is a couple other things we should mention, and that's the tax credits and deductions. So a tax credit reduces your taxes by the full amount, whereas a tax deduction reduces your income. So what that means is, as a rule, tax credits are more valuable because it directly subtracts. So if you get like $100 tax credit, you owe $100 less, but your taxable income. So let me show you an example of this. So Shiro's in the 15% tax bracket, itemizes his deductions. What will his tax bill be if he makes a $1,000 contribution to charity versus his tax bill if he gets a $1,000 tax credit for his son? So the tax bill, the reducing for the $1,000 contribution means that since he's in the 15% tax bracket, he's going to end up only getting a credit of $150. Because they're taking it away from his income. So he's no longer paying this $1,000 in his income. So he's no longer paying 15% taxes on it. Versus the credit, which is a $1,000 credit goes right into his taxes. And often too, if you don't owe, you get that money. You get that $1,000 from the tax credit.